Hello, welcome to BISP trainings. My name is Ashish Kumar Jain and I would be taking today a session on capital budgeting. So before beginning about the session, let me tell you something about myself. My name is Ashish Kumar Jain. I am a techno-functional consultant with 5+ years of experience in various Oracle applications such as EPBCS, EPRCS, and Hyperion Planning 11.1.2. So in capital budgeting under project module, we have the concept of planning projects, particularly capital projects, for the purpose of studying its feasibility. Before beginning with what we have in our application, let's discuss what actually is capital budgeting. So, capital budgeting by definition is the process that companies use for making long-term investment decisions. For example, some of the capital budgeting decisions that are required are for acquiring new machinery or for replacing current machinery or with regard to launch of new products or spending on research and development. So why capital budgeting, or what is the importance of capital budgeting? So uh, s- in capital related projects where a large sum of amount is requires for the feasibility study of the project with regard to whether the investment decision that an organization is taking with regard to making such investment would be beneficial to organization or not, since these kind of capital budgeting projects have a long duration of time and a significant amount of capital is tied up. The principle of capital budgeting can also be used in making certain operating decisions such as investment in working capital or acquisition of other companies. Now, what are the kind of capital budgeting projects? So there is four major classification of capital budgeting projects. First being replacement projects. So replacement projects means these projects helps in maintaining the normal course of business and do not usually require very thorough analysis. For example, if a piece of equipment becomes obsolete, the decision whether to replace it usually does not require detailed analysis. Replacement decision that involve replacing existing equipment with more efficient equipment or with newer technology usually require more detailed analysis. Then we have extension projects. These are projects that increases the size of business. Expansion decision require more careful consideration compared to simple replacement projects because there are more uncertainties involved. Then we have new products and services. So venturing into new products and services brings added uncertainty to firm's overall operation. These decisions require extremely detailed analysis along with the participation of a lot more people in decision making process. Then we have regulatory safety and environmental projects. These projects are sometimes made mandatory by government agency and some external party. Now in capital budgeting, uh, net present value becomes one of the major key performance indicator for assessing any project. Now, what is net present value? For a project with one investment outflow which occurs at the beginning of the project, the net present value of the future tax cash flow minus the investment outflow. That is, considering the time value money concept, the total outflow and total inflow resulting into the present value of cash, taking into account the discount rate or the inflation, an organization is required to calculate the net present value of that particular project. And then there are certain decision rules for net present value which are taken into account in order to proceed with a project or not. Now, what are the decision rules for NPV? net present value should always be greater than 0. A net present value with negative 0 value must not be undertaken, and a net present value has with 0 has no impact on wealth creation. Second important parameter or indicator for assessing any project, capital project, is benefit to cost ratio. Now, if a project has a BCR greater than 1, the project is expected to deliver a positive net present value to a firm and its investor. BCR is calculated by dividing proposed total cash benefit of the project by the proposed total cash cost of the project. Okay. The formula for BCR being net present value of cash or use of cash divided by source of cash, that is the cash inflow. Now, I have a scenario, a simple scenario considering the capital planning required for an organization. Now, the scenario says for an initial investment in a capital project for an equipment purchase of 30 million, we have a labor charge of 0.25 million and a freight expense of 0.5 million, which generates after tax cash flow of 10 million, 14 million, and 18 million in respective years. Now, the discount rate provided is 10%. Now, let's discuss this same scenario in application, and we will cross verify and validate the numbers in Excel also. So, to begin with capital budgeting project, we go to projects, and under projects, we go to project summary. And in order to create this particular project, we need to add a project. Now, to add a project, we just go to action and we add project. Now, let me define the name as capital project 1. Now, since we are planning for a project and say this project is to start in the next month, Jan, and since this project is required to have a cash inflow for subsequent 3 years. So let's the end date of project be December 31st, 2024. I just launched this project and we get a line item added with the project name as capital project 1. Now, project description could be provided based on the user requirement. We could set the priority of the project. So priority could be set to high, medium, or low. I'm right now setting it to high, and you could rank the project accordingly. So I am ranking this as 1. We just save this. Now, for this particular project, as per our scenario, there is an expense of 30 million for equipment purchase, 25 million for labor charges, and 0.5 million for expense or freight charges. So let me just add those expenses. Okay. So to add expenses, we go to cart expense and we just select our project. So my project being capital project 1, and I just go to direct input and provide with the direct entry of all the line items of expenses. So my very first line item expense being equipment purchase. So it's an equipment expense, and this particular equipment expense is occurring on the first month of uh, financial year 21 as per our scenario. So let me just add the value as 30 million. Okay. Now second line expense that we have is labor charges of 0.25 million. So let me just add labor charges. So we could identify all our expenses. There are multiple category of expenses as per the user's requirement. So being 25 million, 0.25 million, sorry. So 0.25 million as a labor expense, and then we have our fried expenses. So fried expenses being our travel expenses. Okay. Okay, so once done, we just save our expenses, and we need to run the business rule within the form to calculate all expenses. So just calculate, and the system will calculate the expenses accordingly. Then we have our cash inflows in subsequent year. So financial year 22 will give us a cash inflow of 10 million. In financial year 23, we have a cash inflow of 14 million. And say in financial year 3, we have a cash inflow of 18 million with the discount rate of 10%. So I just provide with the inflow of cash under project financial benefits. Okay. And the kind of benefit could be either support revenue or sales and distribution service or product revenue, or you could add your classification of revenue. Right now I'm considering that this particular equipment will provide us with some service revenues, and this service revenue will result into inflow of cash of 10 million in financial year 22, and 14 and 18 million subsequent year. Okay, you just save after providing with the input of data and the and then we need to run the business rule to calculate benefits, all the benefits that the project, the inflow of cash will result into. Once done, we just have to provide with the discount rate. So the discount rate being 10%. So I have the discount rate submitted here. I just save this, and we just move to project summary. Now if I just go to capital project overview, the calculations haven't taken place, the net present value haven't taken place, and the ratios have not yet been calculated. So in order to make the calculation, we go to project details again, and we just calculate this particular project to get all the desired ratios and numbers being calculated by application. So once you click launch, the rule will run to calculate the complete project related values, that is the net present value, total investment, total profitability, BCR ratio, and other. Now also you could provide with the project capitalization. So what does this project capitalization means? So capitalization is a functional concept which says that whenever an organization have a capital asset purchase, so that organization could capitalize all the expenses related to that purchase, and all that expenses is then uh, is then utilized as PPE expense, that it becomes the part of capital asset, that is property, plant, and equipment. So let me just take down these assets. So we had equipment expense as one of our expense, and the capital expense being acquisition cost. So I just take it as acquisition cost, and I say that 100% is our capitalization. And since this equipment purchase will belong to one of the asset class, so I keep it as machinery and equipment, and I provide with one of capital asset details. So we have certain predefined capital asset members created. I just utilize CIP1. Then the second expense that we had was of labor expense. So I just take labor expense, and I use this capital expense as some additional charges. Now, since labor expense is not uh, uh, a part of capitalization, I just keep this capitalization as zero. Asset class will again belong to machinery equipment, because the total cost of the this particular capital project expense will become a part of PPE. The capital asset detail again being asset one, and then the last part is the travel expense. I take up travel expense, and these travel expense being part of category as freight charges, so I just utilize it as freight charges and say want to take only 80% of its value as capitalization. Again, the asset class will belong to machinery equipment because in all it will become the part of a single asset CIP1, and I provide with asset detail again as CIP1. After providing with the detail, you just click save, and the system will calculate the capitalized cost for this particular capital project that we are planning in the coming near future. So after the calculations are done, we had under total project expense our capitalized expense cost. Okay, so once done, the total project expense was 30 million 30, and the capitalized cost being 3,004,000, that is 30 million and 40,000. Okay, now for this particular project, there are certain expenses associated because being a capital project and an equipment, there are certain expenses associated with all capital assets, being depreciation, amortization expenses, and other expenses such as repair and maintenance expenses, tax expenses, fuel and gas expenses, and other expenses. So I just provide with the in service date in here to calculate the expenses associated with this particular project. So I provide the in service date as the project start date. I provide with the depreciation method. So for us, this depreciation method is straight line, and I provide with the depreciation convention. So I keep it as pro rata begin period. Once done, I need to save this, and I could just calculate all the expenses associated with this. I just click calculate depreciation, and then a depreciation and other expense calculation will take place, and the same could be seen in our capital module. So the numbers get pushed from your project module to capital module. If I just go to capital project overview, all the calculations could be seen. So we have a present value calculation in here. We have a project benefit. We have our total project cash flow, and we have our benefit cost ratio being calculated apart from the pictorial representation of total expenses that we incur. So one of the our expense being very small value, so it is not reflecting, it is just providing with a small graphical view. If I just maximize this, we could see this. So 50,000 being our other direct costs and total expense cost accordingly. And we have our capitalized and non-capitalized pictorial representation and total project expense value in here. Now, if I just move to analysis, I could check out the total cash flows associated or related to this particular project. So if I just go to project cash flow, you see we have a cash use of cash in here, and then we have a source of cash, and in all it calculates total project cash flow outflow and total project cash inflow at the end. If I just take a smart view poll of it, we will do the calculation of net present value and BCR ratio for cross validating the numbers and to see how the calculations takes place. Okay, let me just refresh this, and we will have a numbers populating in here of cash flow. Okay, I didn't get the numbers. Okay, I need to connect to the sheet first. Let me just connect this sheet, and we will have this cash flow, If I just refresh now this particular sheet, I will have the data in here. Okay, I haven't selected the project name, so it's being capital project 1. Once I select the project and refresh, the numbers will populate in here. Okay, so these are the numbers that we have in our application also. Okay, now how the net present value gets calculated? So net present value is actually, there is an inbuilt function in Excel and PV, which is net present value. We need to provide with the discount rate. So for our scenario, we have kept the discount rate as 10%. Okay, and we provide with the value. Okay, we provide with a value. So to calculate net present value, we need to provide discount rate, then we need to provide the values. So these are the three cash inflows. Okay, and we need to add up the cash outflow, and it will calculate the present value accordingly. Let me just do the formatting. Let me just reduce the numbers to check whether we are getting the same number or not. So we are getting net present value as 3884823, and our application is also calculating the same value. Let us check. So we have the net present value as 3884823. Okay, we have our return on interest as 38.61. So return on interest is the total cash involved or cash outflow divided by total cash inflow. So it results into calculating the return on investment, and BCR is use of cash divided by source of cash. So we get the value as 1.39 for benefit cost ratio. We have a project benefit of 117. Okay, with the cash outflow being calculated accordingly. So this is how you could manage or study the feasibility of any capital project within the application, which gives us all the KPIs and numbers accordingly. And also, if we move to capital, we could check for all the expense related, uh, asset related expenses, such as we have our insurance expense, maintenance and repair expenses, and depreciation expenses calculated for this particular project. So this is what we could achieve in capital project planning in PBCS application. Thank you.